Hey YouTube, this is Zach with Achilles Financial, and today I want to talk about Delta stock. So we're back talking about the airlines, and I always mention that I am not a believer in investing in the airlines right now, but I do have a spec play that I want to walk through today that I'm going to be using for airlines. Ideally, I'd like to see Delta kind of ride up tomorrow, and that can happen based off some form of stimulus news. But I want to play earnings. They do have earnings, and those are going to be coming up next week on Thursday. That is going to be on October 13th is what I expect that's going to be. So that's going to be next Thursday. As you can see, we've seen a pretty dramatic downtrend from very high levels of profitability over the past few years. Delta has probably been the most profitable airline consistently. And I think that we're going to see some of that trend maybe return next year, depending on what happens. But this is a company that offered a very attractive dividend, and you can see that that is currently not available at this point in time. And I do think that there's going to be some value in playing the earnings. But because the earnings plays are relatively expensive, especially on the put side, you can see that there is a fair amount of short interest, and 3.16 is a decent amount. But what we're looking at is we have the capability to really make a good play on taking advantage of the Delta earnings, especially if we can ride some of the airline optimism that may be coming after we get some relief from Congress, from some form of stimulus bill, and that is particularly targeting the airline industry. You can see that there is not a lot of positive ratings going on for the airline stocks. And I would agree with that, but I think that we're going to be able to ride up some momentum, especially if there's any form of a deal that goes through. So let me show you the credit spread play that I want to use. So what I have up here on the screen is just the Delta stock price from the past. I'll put it on the weekly. And you can see that they have done pretty well over the past week. A lot of this is riding up off of stimulus hopes, especially what you saw this past Monday. That is what occurred here. However, there's this rising upwards, but realistically, we have not seen a lot of potential for these stocks in a while. And so what I'm going to be looking at here is what is the potential for us to really view this on an ongoing basis and potentially make a play here. The way that I plan on playing this is what I'd like to do is open up a trade, and we're going to be playing the call side. So they announce earnings next week, but instead of playing the 16th, I want a little bit more time to tap into that premium. And I'm going to be looking at the $38 calls. The reason for this is because Delta has not touched 38 and near on 6 months. So the highest I've seen them get is around the 37.50 mark, and I don't anticipate that they're going to get close. I don't anticipate earnings to be necessarily a positive event, even if there is some optimism on cost savings. So what I'm looking at here, as you can see, the $38 spread is being priced in at $43 a share. So instead of buying that, what I'm looking to do is sell that option. And as you can see, that presents this probability right here. So if I sell it, someone is paying me $31. However, for me to sell this naked call, I need to be able to have a lot of cash to be able to support it if it does go higher than that amount. So instead, what I'm going to do is a credit spread. And I'm going to go out to that same October 23rd. And I'm going to go to a farther out of the money option, and I'm going to be looking at this $39. So the difference between these two, that $1 means that whatever this price is, I'm going to require at least $100 of collateral value. So right now you can see that this is a $15 spread. There's a little bit more optimism on Delta. So if we saw a run up that is a little bit more reminiscent of one of these up days, then we're going to have a little bit more benefit in getting a better spread price. But for this sake, let's say it's $15. I'm looking at doing 5 of them. So what that means is that I'm going to be putting up $500 of collateral for this trade. So as you can see here, this is going to require $500. That will be $15 there. And what this means is that I am getting paid $75 making the statement that we are not going to see a greater than $38 strike price. So that initial investment is someone is paying me $75 for access to my $500 is really what I'm getting. So the worst case scenario here is I can lose up to $425. So if you look at that and you say, Zach, that doesn't make sense. Why would I put up $500 for $75? I mean, my risk reward, my risk is $425, my reward is $75. Well, what I'm looking at doing here is just some of the probabilities. The reason there's a higher risk is because it's a much safer reward. And so I'm not going to get a lot of reward because I'm not taking a lot of risk by potentially losing all my money. I'm guaranteed that $75. But when I look at that October 23rd that we were just mentioning, the probability that that's going to be in the money, according to this chart, is 13.95%. The 39 is only 9.5%. And this is my worst case scenario. So that risk premium is going to increase the closer to the money I get. Now, do I think that Delta is going to be at $36 a share? Not necessarily, but it could still happen. However, just to showcase the difference or how that could be priced in here, if I go into $36 a share, so if I do that same exact trade, but instead of it being $38.39, I do $36.37, you can see that now I am getting paid $21 a share, which means that my total risk is going to still only be that, or rather it's still that $500 collateral if I do 5 options, but my total risk is now only $395 because someone is paying me for $105 to take on these options at a higher price. But again, it's closer to the money, so there's a higher risk of me losing this. What you can do though, because the two ways this is priced in is time and volatility. So the closer that we get to that time period, I can always buy these options back. And this can give me some cash on hand, but this is a great way to use some of the cash you just have sitting in account if you pick the right options. This does have an element of risk. However, there are some safe options out there, but I just want to play some of the increased volatility associated with the earnings run up. The other item that we can change is the time period by which we're looking at. So that same option a week later is now $34. It still only cost me $500 because I'm doing 5 options, but my risk now is only $330 and my gain is $170. So right now, if I place this option that you see here, and then I walk through the full process where I went all the way until expiration and someone paid me $170, then that would be a 34% return on investment over the course of a single month. And it's a fairly risk-averse play. And we can see the probabilities associated with that when we go to the options. We look at these October calls. Again, 36, the probability is 25% and 18%. So it is higher. We do capture that risk premium, and that's because of the time. You can always buy back, but that's a potential 30% return on investment. So this is a potential spread for Delta. I think it's a great way to use up some cash that you have laying around, and I'm hopeful that you utilize it and you're able to make some money. So if you'd like to see some more spreads that I'm going to be evaluating, let me know in the comments below. I'm a big fan and I think there's a lot of possibility here. So thanks for watching. If you found it helpful, please leave a like and subscribe. Thanks everyone.